Did you know that the Japanese stock market just had its worst day since 1987, dropping a massive 13% in a single day? This sudden plunge has sent shockwaves around the globe, including here in India. But why did this happen and what does it mean for your investments? Let's ride and find out. Alright, so let's start with what happened in Japan. Now, imagine you have a piggy bank where you save all your money. One day you decide to take out some money, but suddenly the value of all the coins inside drops. This is kind of what happened in Japan. The Japanese stock market, where people invest their money in companies, fell by 13%. This means that the value of all those investments dropped sharply. Why did this happen? The main reason is that the Bank of Japan, which is like the country's central bank, decided to raise interest rates. Think of interest rates as the cost of borrowing money. When interest rates go up, borrowing money becomes more expensive. This means companies and people borrow less, spend less, and invest less. In Japan, this caused a lot of people to panic and sell their investments, leading to the sharp drop in the market. Now let's talk about how global economies are interconnected. Imagine if one part of a spider web shakes, it can cause the whole web to move. Similarly, when something big happens in one country's economy, it can affect economies around the world. For example, if the UK or China make a big economic decision, it can impact the US and other countries too. When the Japanese market fell, it caused a ripple effect. Investors around the world, including in India, got scared and started selling their stocks. This led to a significant drop in our markets as well. Imagine you're at a busy market and someone yells that there's a fire. Even if there isn't one, people might still panic and run away, causing chaos. This is similar to what happened in the stock markets. Let's look at some real life examples. When the Japanese market fell, the BSE Sensex in India dropped by nearly 2700 points, and the NSE Nifty fell by about 825 points. Major companies like Tata Motors and SBI saw their stock prices drop significantly. This means if you had invested in these companies, the value of your investments should have gone down too. Another factor is currency exchange. Let's break it down with an example. Imagine you borrow 1.3 million Japanese yen at a low interest rate of 0.5%. You convert this to $10,000 and invest it in a US Treasury bond that pays 5.5% interest. After a year, you earn around $10,550 from your investment. If the exchange rate stays the same, you can convert this back to 1.37 million yen. Pay off your loan of 1.3 million yen plus interest and keep the profit. But what if the yen strengthens? Now, your $10,550 might only convert back to 1.25 million yen due to the higher value of the yen. This means you don't have enough yen to repay your loan and you lose money. This is what happened on a large scale, causing a lot of financial turbulence. So, what should you do as an investor? The key is not to panic. Markets go up and down and it's normal. If you sell all your investments out of fear, you might miss out on potential gains when the market recovers. It's important to stay informed and make decisions based on long-term goals rather than short-term fluctuations. In conclusion, the recent fall in the Japanese stock market has caused ripples around the world, including in India. Understanding why this happened and how it affects us can help you make better investment decisions. Remember, it's all about the journey, not just the destination. If you enjoyed this ride and our discussion today, make sure to like, share, and subscribe for more content. Until next time, ride safe and keep exploring.